Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Friends, in this video, I'm going to talk to you on the topic control your FOMO. What is FOMO? It's a fear of missing out. FOMO is there in every investor because all the time we think a stock will come down and we can buy it at a cheaper price. The stock does exactly the opposite and moves up very fast. We don't want to miss out and we end up buying at high prices simply because we are afraid the price will go even higher and completely out of our reach. The fear of missing out mostly makes investors take hasty investment decisions, deploy money in a manner which is indisciplined, and create a portfolio which has valuations that have not been managed well. The entry valuations tend to be out of whack and most people overpay for stocks which they bought when they come under the influence of the fear of missing out, which I call as the FOMO. Now, the domestic investor is very much worried that he will not be able to buy some parts of the market going forward. These parts are thematic like defense or a category like small cap. We see that investors are buying their entire positions in a stock in one day. And on that day, the stock would probably be at a high. It would have already gone up 7-8% on that day. The investor goes and buys that stock. Investors are clearly getting tired of waiting exactly at a time when waiting may be the best thing to do in expensive stocks or in expensive themes. This is again not unusual, but when retail investors do this, they are only setting themselves up for a prolonged period of pain, a phase when they need to simply sit and pray that they will be able to make good for their hurried buying. Every market cycle sees this FOMO factor rise and ebb. It is when it is very limited, when there is little or no FOMO, when there is no fear of missing out, is probably the best time to invest in many themes. Most themes give you investment opportunities at valuations which are favorable to you when there is very little fear of missing out. And when that fear of missing out is very, very high, you are not going to make bargain buys. You are just going to make buys because you are afraid that you will miss out buying. Now, that's not a great way to invest, and that's not a way which will create winning investing. A lot of people had it lucky in the past when they bought stocks on the rise simply because that overvaluation went to extremes and even made these indisciplined investors make quick money. But it won't be the same all the time, and it could be different another time. And that's why investors should brace themselves up for more difficult times and buy only if the valuations are what they really liked and what they agreed upon to invest. If the markets run away, one should be ready to sit on cash. And one should invest only in specific stocks or themes where the valuations are completely in favor. Don't overpay now because there is no great reason to overpay now simply because valuations have run up. When you pay more to buy a company or a theme, there should be a very valid argument, something that will justify your overpaying, where you will see the earnings of the company rise significantly immediately or in a short burst of time, or where you will see growth accelerate in that theme. If you don't find those things, then there is no reason for you to rush into buying when valuations have risen. This is a very simple thing to follow. It's very easy to understand. but very difficult to practice. And that's exactly what investors should do now, which is control the fear of missing out, be ready to wait it out, gather your cash, sell selectively where you feel the valuations are too stretched, and always wait for a rainy day when the fear of missing out will be very low. Nobody is bothered or worried about missing out, and that's when you should not miss out. Thank you for watching this video.